STANLIB webinar this afternoon. My name is Ehret, Head of Retail Distribution at STANLIB, and I have the pleasure of being your host this afternoon. I'm also joined by Marius Oberholzer, who's the head of our multi-asset business at STANLIB, and thanks to Marius for taking the time to join us today. Really appreciate it. And we look forward to hearing some investment views and thoughts from Marius in terms of how they're managing some of our portfolios and how they're looking and navigating through some tough, volatile markets at the moment. Before I hand over to Marius, I'd just like to do a quick recap of some of the changes we've made to our multi-asset propositions over the last kind of 12 to 14 months. So in April last year, we announced that we were consolidating at that point in time, two multi-asset businesses into a single center of excellence for multi-asset investing at STANLIB. And that business is headed up by Marius and his team at STANLIB. And through that process of consolidating our investment franchises into one center of excellence, we also took some of our funds and consolidated them into Marius's business. So the old STANLIB Balanced and STANLIB Balanced Cautious funds moved to Marius and his team effective 1 April last year, and Marius and his team have been managing those funds since 1st of April 2023. And I think if you look at the performance of those portfolios over the last 12 to 13, 14 months, really impressive and pleasing performance being generated by Marius for yourselves, and importantly, obviously, for your underlying clients. We then also communicated some changes to the old STANLIB Balanced and Balanced Cautious funds, and those changes came into effect on the 9th of February this year. So just a quick recap, the STANLIB Balanced Cautious Fund, we changed the name of that fund to the STANLIB Multi-asset Cautious Fund. There were no other changes made to that portfolio. And then on the old STANLIB Balanced Fund, we actually amalgamated or merged that portfolio into an existing STANLIB unit trust called the STANLIB Multi-asset Growth Fund. So in summary, our two flagship multi-asset portfolios at STANLIB in the low equity multi-asset category is the STANLIB Multi-asset Cautious Fund, and the high equity multi-asset category, the STANLIB Multi-asset Growth Fund. And as I've alluded to, both managed by Marius, and we were touching on those two portfolios today, and Marius will be giving you some insight into the outlook for those two funds going forward. If I start bringing it back to today and the webinar, we had our roadshow in Q1, end of February, early March, and thanks to all of you who did attend that roadshow. At that roadshow, we spoke about the uncertainty and some key areas that our investment team, not just our investment team, I suppose all managers, would be looking to navigate through the course of this year. The likes of ongoing conflicts around the world, the Russia-Ukraine crisis, the conflict in the Middle East at the moment, which kind of doesn't seem to have an end in sight at this point in time. And then inflation and rates. And we spoke at length about our views on inflation and when we expected the rates or interest rate cycle to turn and rates to start being cut. We sit here in the middle of May now, Marius, and quite a different view in terms of when we expect to see the first rate cut, specifically looking, for example, at the US. Inflation, yes, is under control and is within targets and inflation bands within major economies, but some of the data still suggesting that not necessarily completely under control, which is making central banks not necessarily as comfortable as they'd like to be before they're actually going into a rate cutting cycle. And then elections. I mean, over 50%, I think over 60 countries internationally going into elections or national elections this year. But I suppose more importantly and relevant for ourselves in this month, the month of May, is in South Africa. So later this month we go to the polls, an extremely important election for South Africa. But I think if you read news flow and you look at different surveys and polls, etc., a whole lot of different scenarios that could potentially play out. And how do those scenarios potentially impact markets, potentially impact asset class returns, etc. So I'll hand over to Marius shortly, and Marius is going to be giving yourselves an update on our multi-asset cautious and growth funds, but then also importantly touching on some of those aspects and how he and his team are thinking about markets going forward and how they position the different portfolios through this kind of challenging and volatile market that we find ourselves in. Before I hand over to Marius, and for those on the call who are leaving it literally to the last minute for CBD points, the deadline is at the end of May. Please stay on the call until the end of the webinar. We'll be aiming to be finished by 3 o'clock this afternoon, so in order to qualify for those CBD points, please stay on the call. Marius is going to chat for about 35 odd minutes or so, and then I'll come back at the end, and then Marius and I will have a questions and answer discussion. So please send your questions through on the functionality on the call. And then I'll look to facilitate that Q&A discussion at the end. So once again, thanks for joining us, ladies and gentlemen. We hope you enjoy it, and let me hand over to Marius. Thanks again. Over to you, Marius.
Thanks, Alan, and hi everybody from my side. Alan mentioned that the world is going through a huge amount of uncertainty, and the reality is that I think we've been going through uncertainty for a period of time. Oftentimes in these forums, and when we're on the road with clients, we talk about events that are important to you and that are coming up in the short run. But one of the things that I'd really like to just reiterate again is what we're trying to do in these portfolios and in these funds that we're managing on behalf of you and your investors, and how we got about to building this type of thinking. And I think the first port of call, and I'm sorry if you've seen the slide from us before, but I think it is an important component in that over the last sort of 15, 20 years or so, it would be fair to say that South African multi-asset portfolios have not delivered sterling performance relative to the historic environment. And you can see this slide that shows rolling 5-year and 15-year returns steadily declining in the multi-asset space. We've used just two components or two classifications for this. And I think what that brings about should be a thought process, not just for us as investors about trying to do something better for our clients, delivering the returns our clients need, but also for advisors to ask themselves, have things changed? We're sitting in this world of unprecedented change, not just in terms of AI, but in terms of an environment where the globalization has shifted potentially. We're sitting in an arena of inflation once again waking up. Whether that will be over the short run or the longer run remains to be seen. And we're sitting with the increased geopolitical tensions around the world that may have much bigger knock-on impacts into the investment landscape and how we as portfolio managers and you as fiduciaries for your clients might think about allocating capital. And so over time, as we've thought carefully around how we would manage multi-asset portfolios, and not just in our team, but certainly across the STANLIB environment, we thought that we needed to do something different for clients. And ultimately what we've thought about is that this world that we've sat in over the last sort of, let's call it since 1998, the period of the great moderation, if you like, we sat in a world where fixed income and equities have been pretty decorrelated from one another. And we've hypothesized in this and other forums that potentially that's not the normal world. We've hypothesized as well around the commodity demand that people thought was normal between sort of 2000 and 2008 when China came online as being normal. I think that's been shown to be an abnormal period. And we may well look at this period from sort of 2000 to 2020 in terms of bond equity or fixed income and equity correlations being decorrelated, being an incredibly fertile time for multi-asset investors, but one that has potentially given them the false sense of comfort. And we are not saying that this is the world that we're moving into, that correlations will be positive, but it's enough for us to have thought carefully around how we would build a portfolio of multi-assets that would deliver to client needs, as well as being competitive, of course, because ultimately you do have a choice with what to do with your capital. And so we've shown these kinds of slides over a period of time, and it is a cornerstone of how we think as a team in terms of managing correlations, not just between fixed income and equities, but ultimately between assets. Diversification is important, but you really need to think about the total portfolio and think carefully around correlation within your portfolio, especially in times of stress. So as we've got this slide on the screen, it really just showcases, I think, the traditional balanced world. Nothing wrong with it. It served investors fantastically well, not just internationally. Within South Africa, we saw investors shifting the opportunity set offshore to include more alternatives, to include more asset classes. And in South Africa, we've slowly been doing that over the last sort of decade or so in our business, and obviously more recently in our flagship multi-asset portfolios as we've taken control of those. So just to remind the viewers, what we're trying to do here is bring about our thought process which is pretty unconstrained, not in terms of how we implement in the portfolio. We will always implement within the mandate itself, so high equity or low equity. We're not trying to build you a fully flexible portfolio, but we want to maintain flexibility in our thinking and how we implement our investment ideas. But importantly, while there might be a thought process that lends itself to thinking about building blocks, we want to think about risk at a portfolio level. So we're controlling portfolio at the top level, portfolio risks at the top level. We're controlling it within the asset class level, within time horizons as well. And so there are many levers that we're pulling on to try and step away from a portfolio which historically has been incredibly equity centric. And if equities don't perform, then investors ultimately get that declining return profile that we showed in the first slide. So our thought process as well is we need to be really careful around inheriting factors. One of the criticisms that were made around our multi-asset portfolios historically is that they were slightly too stylized for a specific type of equity component, and we saw that sort of manifest in the 2022 period where growth proxies really came under pressure. And so on the right-hand side, and the way we think about managing portfolios is really to give investors a much smoother ride, a more predictable return profile that should still be competitive relative to the peer group and relative to the needs of your clients, but ultimately allowing you to sleep pretty well at night. So how do we embrace this wider toolkit, if you like? Well, the first port of call, and a year ago, or just shy of a year ago, I sat here just prior to the 2023 Tour de France, and I talked about the makeup of a cycling team with climbers and sprinters and domestiques. And here's our cycling team, again, to stick to that metaphor. The STANLIB Multi-asset team, which comes at things from a variety of different investment backgrounds, in different thought processes and different skill sets. And I would like to remind you that we've built this team very, very deliberately to embrace those different viewpoints, to embrace those different styles and those different skills, be they qualitative, very long-term thinking, shorter-term trading orientated, hedge fund background, my background, or much more quantitative, evidence-based thought processes that lead to much more robust discussions with the team, as well as, I guess, a wider sense of signaling that allow us to make better informed decisions, or hopefully pick up errors within our decision-making process that will again lead to a better outcome for our clients. Importantly, it's not just this team, although we are 100% accountable for the outcomes in these portfolios, but we lean heavily on the wider STANLIB specialist teams, whether that's in fixed income or equity, or actually in other areas of our business where we've got exposure to alternative assets and unlisted assets, where there's a lot of information that we can utilize to make better investment decisions. And then importantly, something that we believe is a really valuable selling point is our combination and our strategic partnership with JP Morgan Asset Management, who are an extension of this portfolio management team. They don't sit aside from us. They are part of the portfolio management team, sitting in our tactical asset allocation meetings, debating viewpoints with us on a very regular basis, us critiquing them and their thought processes, and vice versa. So again, quite a strong makeup here, which gives us a heavily or a very deep resource base to go and do research in areas that we think we might be lacking, or a breadth of investment strategies that we and the JP Morgan colleagues can implement in the portfolios to bring about not just the required returns, but hopefully that volatility of returns being something that we can all sleep with at night. So with that, I think just to remind you some of our investment philosophy, and something that we're talking about a lot right now, is that all assets are risk assets. And as we head into elections, and as we think about the fiscal situation in the world, suddenly people are waking up to the fact that fixed income might not be this dependable, safe asset anymore. And while it may well turn out to be that dependable, safe asset again, I think just the fact that we're aware of these seismic shifts, potential change, and the impact that higher inflation may well have on fixed income looking forward is something that I think our team is well set up to go and think about and go and manage portfolios. We do think carefully around that diversification. I touched on it earlier. Broad diversification, granular diversification, time horizon diversification, geographic diversification, all of those things will hopefully build about a robust portfolio where we don't just want diversification for the sake of it. We want to ensure that we understand why we're investing in things, or how diversification or correlations will impact different assets that we hold, because it does shift over time. And as a result, we are fully embraced in the active management environment. These are actively managed portfolios, both at an asset allocation level and a strategy level. While we might utilize some kind of index strategies from time to time, it's important that you don't think that these are passives. They are anything but. And then hopefully you can hear that we'll be a little bit more dynamic and flexible around our thought processes within mandate. And hopefully I'll give you 2 examples of how we've shifted that over the last 12 months since we've controlled these portfolios. And it goes without saying that there's a deep global expertise in the team. Many of us have managed capital in markets outside of South Africa, as well as in South Africa, and obviously the JP Morgan cohort and our wider STANLIB colleagues add more validity to that last statement around deep global perspectives. So hopefully that's enough around repetition, and we can talk a little bit around why you might choose these 2 portfolios. And I think the first bit is that we are trying to generate competitive real returns. Our cautious fund is there to generate a CPI plus 3 over time for our investors, and our growth portfolio is there to really deliver competitive returns relative to that peer group. Something for all investors there to utilize as a core portfolio solution. It's a high conviction portfolio, so you will see us crowding into assets that we really like and skewing away from assets that we dislike. An example might be listed property, not just in South Africa, but offshore right now, or crowding into high yield credit, which is a big component of our risk budget currently. The other component is the depth of expertise. I won't reiterate that. I think we've made the point within not just the team, wider STANLIB, but also the JP Morgan cohorts that we can pull expertise from. Diversified global exposure, of course, with the Reg 28 changes that we saw in 2022, we can take up to 45% of our asset base offshore. That's a great thing for savers, but it does lead to a much more volatile return stream than investors have had historically, especially given the movement of the rand relative to the dollar or the euro, sterling, or other developed market hard currencies. We're trying to dampen the style bias. We do utilize an exceptional team in Rademacher for Mark, and who's multi-style equity approach for a portion of the portfolio. And similarly, we want to be aware of the style biases that we are inheriting, not just from JP Morgan, but within markets themselves, because there's a high degree of concentration in technology stocks, etc., from the makeup of market cap portfolios. And we need to manage those risks collectively and independently. And then finally, we want to be pretty flexible around our asset allocation and strategy allocation. And I mentioned time horizon and geography earlier, but always within mandate. So for instance, in our growth portfolio, we're very much aware that an investor hasn't bought a flexible fund, so you will see us moving around between sort of 75 and 60% of equity. We think that that is what you've asked us to do, rather than swinging from 0 to 75 in a more flexible type environment. So we are managing that flexibility within the mandate and the client promise. But ultimately, what we think you're going to get over the long term will be a dynamically managed portfolio, actively worrying about correlation, actively worrying about risk, and a fairly consistent return profile and a consistent volatility of returns that we're trying to control as well, rather than giving you a lumpy return one year and a really depressed return the next. Nothing wrong with that style of investing, it's just not for us or the wider business. So how have we done over the last 12 months? And let's just caveat the following by saying we realize it's a very short-term number that we're going to show you. And it's been a pretty difficult environment to navigate. We were pretty cautious on the world through the period of 2023. We actually thought fixed income would be the place to generate returns. It was anything but. And of course, at the back end of last year, we saw risk assets doing really well, as well as fixed income come raging home, with the potential of a pivot from central bankers or an easier monetary policy environment. So our multi-asset cautious fund here delivered an 11.25% return for investors. That is a gross of fee number. And the benchmark, as we mentioned earlier, is CPI +3. So delivering in excess of the benchmark for investors pretty handsomely. And you can see that 3 and 5 year number that Herman and Hank had been delivering, I think, a reasonably compelling return profile for investors, not just in the shorter run, but certainly over the longer run, relative to the opportunity set that was available over the last 12 months. And we've done that, I think, fairly consistently, and the volatility profile we think has changed. More on that a little later. In terms of the growth fund, Alan mentioned that we started this portfolio in October of 2022. And then merged the portfolios in February of this year. So what we're showing you here over the last 12-month period is the return profile that the team and I have generated. And then, just to be very clear, while we're showing that as a gross of fee approach, the ASISA classification for high equity multi-asset funds, we've taken an aggregate fee number of 0.8%, and we've grossed that up, so we are comparing gross returns with our estimate of the peer group average fee to give you a gross versus gross comparison. And you'll see over the 12-month period, we've delivered excess returns relative to the average in that peer group. And again, I think we've done that reasonably consistently with a reasonably low degree of volatility for investors. And I think, importantly, we need to acknowledge that, especially over the last 3 months, where South African equities have lagged the external equity markets, developed market equities, we have continued to deliver that return fairly consistently. And that is a feather in the cap, not just of the team, the wider STANLIB team, but again, our colleagues at JP Morgan Asset Management, who manage a portion of the offshore component for us. So I mentioned earlier, and I think the title of the webinar is maybe approaching the world and thinking a little bit differently. And I mentioned that we don't want to lean only on equity risk premia to generate returns. We want to spread the return profile a little bit wider. But we thought we'd give you 2 examples of how we might do that. So this, we're about to go into a session or a period of time where we look at our strategic asset allocation mix. We do this fairly regularly as a team. So this is sitting at the end of March, or our estimates for what the next 5 to 7 years might look like in our team. And you'll notice that while this is not an exhausted list of assets and volatilities that we expect these assets not just to generate in terms of return, but in terms of volatility as a measure of risk, you'll notice that SA cash on the far left-hand side screens pretty attractively from a return profile, right? And certainly from an offshore investment perspective, when you look at something like US Treasuries as a US investor, relative to longer end bonds, etc., cash does look very attractive, and therefore the return profile is pretty flat as we look out. This is a very valuation-based approach, but it helps us think carefully around what the longer term portfolio might look like as we think about the design of a solution. One of the things that we've been doing in my time since I've been at STANLIB, which is a little bit more than 10 years now, is currency hedging. And we think that that is a component not just for controlling volatility in a portfolio, but it becomes especially important in the world where 45% of your assets can be sitting offshore. My colleague David McNay wrote a paper, it's on our website, extolling the virtues of currency hedging. And what we've done here is we've taken those same assets and we've added a currency hedge in each case. And what you'll see is broadly a shift higher in returns and a shift to the left in terms of volatility. So ultimately, by currency hedging, you're giving an asset offshore a slightly higher return because you're earning what we call the forward or the interest rate differential between South Africa and the offshore asset, but you're also changing the volatility profile because you're taking away the rand volatility, which is pretty high from a currency perspective. And so while we're big believers in hedging, and we've heard many of our competitors out there now moving in terms of a similar mindset around thinking about currency hedging, it's important for us to also recognize that it is not always appropriate to be fully currency hedged, or to think carefully around how do we currency hedge. Historically, when we look at currency hedging, investors will buy an asset and they will sell a currency forward for 6 or 12 months, right? And they will extract that forward rate, which is the interest rate differential, as I mentioned, and therefore when the rand strengthens, they make money from that currency hedge. And our view is that currency hedging, while in the long term has been incredibly appropriate, and in the short run we still think is appropriate, the way you currency hedge matters. And this chart showing you here is the 1-year interest rate differential between the South African or dollar rand, so a rand asset versus a US asset, and you can see that it's been steadily declining since 2009. And in fact, if we extended this chart back to the 98 period, if those of us who can remember the emerging market crisis and long-term capital crisis of that period, we had interest rate differentials of almost 16%. At that point in time, it's an absolute no-brainer to currency hedge, because it's very hard to see a currency devaluing to a significant degree in this short-run period. But you can see that as interest rates have climbed around the world, or certainly in the United States, we now sit at a point in time where that interest rate differential is only 3.5%. And given that the South African landscape from a political perspective is fraught with concerns, and the fiscal environment, not just in South Africa but around the world, is slightly different, and we're living through the seismic change of deglobalization, etc., earning a 3.5% forward as a means of currency hedging is potentially fraught with giving up a lot of the upside. And hence our view is that you need to think about currency hedging through the lens of options. While that interest rate differential is high, highlighted here by the green, happy to use forward rates, but when we start looking at the world where only 3.5% interest rate differential comes in, we need to think differently. And so skewing into the options market, implied volatility would give us additional returns, and what we call the skew would give us an additional return on top of the interest rate differential and on top of implied volatility, and we'd manage those option strategies pretty carefully. But you'll see from these charts, not just has the skew fallen, but implied volatility has fallen as well, and meaning that we need to think a little bit differently around currency hedging in the environment that we now find ourselves in, where 3 of the return profiles that helped currency hedging being a cheap way of extracting returns have now changed. And certainly since May of last year, when the Lady R happened, we needed to think differently around the strategies that we deployed in currency hedging. So what we've shown you here is a combination of the cautious fund over time, both pre us managing the portfolio and post us taking over the portfolio, and then a spliced time series between the old balanced fund and our growth fund. And you can see the aggressive nature of currency hedging that we take on to control volatility, and when we think that it is appropriate to currency hedge aggressively. You can see right now that the currency hedging component has become much less prevalent as Rand has strengthened, and in fact right now we've got very little on in currency hedging because of the election coming up, as an example, but also because of the environment around the skew and implied volatility that I showed you earlier. But what you can see here is incredibly, was a lot more active around currency hedging than Herman and Hank would have done, and I suspect many of our competitors out there. Again, it's not to say it's better, but we think it's an important component of managing the volatility and controlling the granular risks that we're putting into portfolios. The next component I want to just show you is how does that translate to an offshore versus onshore allocation, very broadly speaking. And what we've got here is our exposures that we are managing in multi-asset cautious, and then again the old balanced and multi-asset growth fund that we have now. And you can see on these two examples that the range is much higher. We're happy to have more assets offshore in the post-April 23 period relative to the 3 years prior that Herman and Hank were managing the portfolios. And you can see that the variability is to a large degree much higher in the thicker bars. So we do move that around on average much more than the previous managers did. Again, I want to make the point that that's not necessarily better, but we think it's important from a risk control perspective. The next component I want to highlight is a similar chart, but then talks about what we call conditional value at risk. And that is one way, only one way, of evaluating risk at a portfolio level. And the blue bar shows you the multi-asset growth fund or multi-asset cautious fund in the 3 years prior to April 2023, where you can see the variability of that conditional value at risk really moves around a lot. And in our viewpoint, that was too much risk, too much variability, too little predictability of the return profile relative to the much narrower set of conditional value at risk data points that we're showing here over the last 12 months. Again, I reiterate, very short term, 12-month period relative to a slightly longer term period. But what you can see here is that we are controlling risk, but we're not giving up the return profile that I showed you earlier over that 12-month period. That speaks to the different approach, working hard at diversification, controlling risk carefully at the portfolio level as well as the underlying strategy level. So those are two components to show you what we're trying to do and hopefully bringing it to light. And there are many others that we could do. Obviously, the time period that we have today limits that to some degree. So as we pivot into the world of, what are the opportunities, how are we seeing the world right now, and how are we positioning your portfolios? We work on a scenario basis, and really recently as a team, we sit down every week and we go through our scenarios and think around where are we in the world. And at the moment you can see that we're feeling reasonably tilted towards risk in the green bars. We've got 6 scenarios, 3 sitting in good outcomes for markets. But you'll see that while the green outweighs the yellow or the red being okay outcomes for markets in yellow and really not such great outcomes for markets, you can see that we do sit in a world where we think a scenario called buy the dip, which is ultimately a pretty volatile environment driven by policymaker response and investor behavior around fixed income, inflation, etc., versus a world that we've been slowly thinking about over the last 2 years or so, which we call new regime, and I'm going to touch on that a little bit later. But ultimately, this is a fairly constructive view on the world in terms of our scenario planning, and you can see the evolution of good outcomes, bad outcomes, and so-so outcomes through a fairly long period of time, and you can see how that would shift in our thinking and ultimately should translate into portfolio action in these portfolios. So what are the top of mind thought processes as we sat, not exhaustively, at the end of March 24? Clearly geopolitics remains front and center for everybody. And I think while it's not just the Ukraine war or the war in Israel and Gaza that's going on, it is around the response to these actions as well as political actions. We've got an election coming up in the US, and we've already seen just the rise of Donald Trump resulting in policy action in Europe, extra defense spending. We've seen aggressive reshoring of assets with the Inflation Reduction Act and the CHIPS Act. And as we look forward to both Biden and Trump running into the November election, we continue to believe that policymakers will run large fiscal deficits, which makes monetary policy much more difficult for central bankers to really move to this world of cutting interest rates, especially while the data remains slightly sticky, as Kevin would lead us to believe. And while that is tending to moderate, it is this last mile of inflation does look a pretty tough one. We spoke about it when we were on the roadshow in January and February, that we felt the markets had got much more ahead of themselves than they should have with regards to the interest rate cuts being priced in the United States, Europe, and the UK, and we've seen those rate cuts backing out. What's been really surprising to us is that equity markets have been able to shrug off those higher interest rate forward-looking environments and battle on. And that is notable and very constructive as well for risk-taking. We mentioned fiscal support as we look forward, and it's making life difficult for policymakers. We're starting to see manufacturing improvements taking place across Asia, China, and even in South Africa at the margin. And we do care about what happens at the margin. AI is something enormous. The technological advancements can't be sneezed at, and we've seen how AI and the theme itself has driven the United States equity market, specifically the S&P, and the concentration risk that comes in to the S&P 500, and that's been a real driver of returns over the last 6 months, especially in equity markets. We don't believe that that's going to go away, but what does concern us, and we've looked at the numbers fairly carefully, is that valuations do look a little rich, potentially justifiably so, given the productivity improvements that we envisage would come about. I don't think we're alone in thinking that, but we notice a high degree of capital expenditure coming through in these technology companies, which should crimp earnings at the margin in the short run. And it's going to be interesting to see how that plays out. Of course, in a world where central bankers accept higher degrees of inflation than we have in the past, even with decent growth because of this fiscal pump priming, we need to ask ourselves, in a new regime, is that good for bonds or fixed income, or better for equities? And the real concern, if you think back to the correlation chart that I showed earlier, is that bonds continue to derate in a world where there's ever higher inflation. And again, that's not a base case, but we are open to this fact that the world may well be changing, and even a dinosaur like I have come around to the fact that inflation prospects are shifting quite dramatically relative to the world of deflation that we saw earlier, and most evidenced in the fact that Japanese 10-year government bonds are now trading close to 1%, and Japan is moving into an interest rate hiking cycle. At the same time, we've got gold prices moving higher, commodity prices moving higher, not so much from demand in China and growth only from the manufacturing side, but also as people try and diversify away from the dollar, and the global south especially spreads its reserve currency, and gold has done incredibly well over the last few months and quarters. And then finally, it would be remiss not to talk about the political situation, not just in South Africa but around the world, as elections take place, and the change of political parties in a place like the UK, potentially in the US, and in South Africa, where we might well get used to coalition politics. And coalition politics is a messy place to be, and I think we're all aware of the developments that we see in the polls, and maybe I'll just move on to that in a second in the interest of time. The first part to talk about is Kevin went and sat at our request and spending a lot of time with political analysts. Let's first acknowledge that the geopolitical edge that we have within the business is somewhat thin. Kevin's well suited to this, as well as leaning on those political analysts to come up with 5 scenarios for us to contemplate as we move into the elections at the end of the month. And the first scenario was really a coalition partnership with the IFP or other smaller parties, where the ANC would still get a majority, because the working hypothesis was that the ANC wouldn't be able to get a majority on its own. The second scenario was the ANC would form a coalition with the DA. As strange as that might seem, we need to be open to that possibility, and clearly with the IFP may make up a far more investor-friendly makeup than just an ANC type government winning a majority. Clearly, risk happens in both directions, and the rise of Mkhonto Sizwe party, as well as the EFF potentially joining forces with the ANC to arrive at a coalition, was something that we felt would be pretty detrimental to asset markets. And then finally, the 2 scenarios where we'd have an environment where we may get a government of national unity, a coalition type environment by any other name, and then an environment where the ANC loses control and really has to bolt on all over the place to get those majorities. And in each of these cases, Kevin's real concern here was that Ramaphosa would come under pressure to step back from the ANC party, and a lot of the improvements that Taryn, Vic, Sly and Kevin are seeing in terms of the state apparatus would be undone. And so as the team and I and others in STANLIB evaluated these scenarios, we came up with a world of, well, how would assets move around in this environment, with a view that actually in all scenarios except the third, where there was this more leftist leaning, investor unfriendly coalition, you would get a bit of a bounce in South African asset prices given the sentiment to SA, valuations and really general investor apathy. To some degree that's already played out. Since we did these scenarios, we've had equities rallying by about 8%, South African bonds will all be up about 2.5% to 3%, and the rand putting in some strength yesterday, trading as low as 18.30 or so relative to the US dollar. So a lot of that we think has started being priced in, and even our fixed income colleagues are talking around the bad outcomes potentially not being priced relative to how they were 6 weeks or so ago. So this becomes a really important part for us to think about in terms of managing portfolios in the short run as well as the long run, because while we might not have an edge in the geopolitical environment, and really more things can happen than will happen, we do still need to manage that path dependency. And so we're working hard, not just in terms of taking more assets offshore into this rand strength, but really thinking about really applying some hedges for adverse outcomes, whether it be in fixed income, currencies, equities in South Africa. So it really quite a difficult time to think you have an edge. These scenarios help us define what we think asset markets might do, but sadly a lot of that move we think has already taken place. And then finally, as we look a little bit further afield, my entire investment career, for my sins, I've been investing in Japan, and it looks like things are finally changing with that market finally making new highs after 35 years or so of being in the doldrum, and Japan moving out of deflation. That is shown up very clearly in the Japanese yen losing almost 40% of its value in the last 18 months or so. That shows you that the world is not necessarily normal, and we're going through seismic shifts, and they manifest quite quickly. We do think we're in a much more volatile world than asset markets are currently showing up because of that fiscal environment that we're sitting with. We talked about AI. I won't belabor the point. It's clearly the biggest technological advancement that we will see in our lifetimes, unless Elon sends somebody to Mars, of course. And then real estate and global real estate is the confluence of credit as well as the world in a post-COVID world where we may well get a pretty big credit event manifesting itself over the next year or two. We've already seen that in China, although that wasn't so much in office, but much more in the residential space. And we are starting to see the real fire sales taking place in property markets in the US. That could be extended into private equity and alternative assets, and we wrote a piece a few years ago talking about the unicorns and the knock-on effect of leverage and a higher cost of capital at a point in time. And so will this cost of capital that we've seen, and everyone expecting interest rate cuts to come down, with this higher for longer world that we sit in, what breaks, when will it break, and how will it play out? Very difficult to know, so we need to manage for the long term and for the short term. And so finally, we just want to reiterate that we think we're well equipped as a team and as a business to deliver on the client promises of delivering kind of market-beating, peer-beating returns, doing it without just worrying about equity markets performing, trying to find new and novel ways of deploying our capital to deliver on those investment returns, but importantly, giving you a fairly smooth ride. Clearly, as part of Standard Bank, the governance structures are strong, and with Alan and his team, we'll try and be as transparent as possible with you around what we're doing. So Al, over to you for some Q&A, I think.
Perfect. Thanks, Marius. Thanks, everybody. Appreciate it, Marius. So let's just, before I go into Q&A, I mean, I just, you've mentioned the importance of risk management in terms of the portfolio, and right up front, obviously you guys took these funds over, different investment process style. Risk management is a central pillar of the portfolio. And I just want to say well done to you and the team. Multi-asset cautious fund over 12 months is first quartile relative to peers, and multi-asset growth fund is second quartile relative to peers, with a strong risk overlay, which I think is really, really good outcome for clients. So well done.
A step in the right direction.
Step in the
long
right
term,
direction.
long way to go.
Exactly. So I just want to, you skimmed over the slide quickly, and with a few questions coming through on asset classes, but your views across asset classes, and it's not often that we see your team having pretty much everything to the right of either neutral or overweight or max overweight. So a question that's come through just relates to people talking about SA Inc. and SA bonds as cheap. I see that on this you overweight SA equity, neutral bonds, but a lot of market players talking about it being very, very cheap. But how do your team look at this? What other lenses do you look at, looking at like those two just specific asset classes, which are quite topical?
Yeah, well, I think
context?
it's no secret that we've hated SA equities for a long period of time, not so much from an asset allocation perspective, but this notion that they're cheap. And we wrote about this in 17, 18, 19, and we talked around rising cost of capital, lower payout ratios, lower return on equities, all impacting the valuations that people should be prepared to pay for South African equities. So don't just look at the historic multiples, look at the world on a forward-looking basis and say, has it changed? And we made the case around SA equities. And we were underweight SA equities in the first part of this year. But certainly at the end of March when we did this, we felt that a lot of the risk was priced into SA equities in the short run. We were starting to see, I think, the global growth proxies starting to pick up in emerging markets, and there's been a lot of stimulus talk in China, and it hasn't come through in a big bazooka fiscal response, but much more supportive environment for the Chinese markets, as well as the fact that with this view of interest rates potentially shifting into a rate cutting cycle, we felt that might be the time for SA equity to start putting in a performance. The other component, of course, and we were on the road with Kevin talking around the fact that some of this reformist area has been underappreciated by market participants. So it's, there's a price for everything, and sometimes when things are beaten up enough, the risk reward changes quite dramatically. And I think that's a reflection of the risk reward changing in SA equities in the short run, as well as the fact that once we get elections out the way, and once we sit with a world where the growth profile of SA just picks up a little bit, there's been no investment. We've had the energy crisis, water crisis, a number of different infrastructure things falling over, that 2024, 2025 could look quite good from an economic growth perspective. Now, not good in terms of raging growth, but Kevin was saying, if you just move from 0.5% GDP growth towards 1.5%, 1.8%, it will feel like a boom. Potentially in our equity markets, and so while investors might hate SA equities, and while we might look at them going from a valuation perspective, we don't think that they're outright cheap. From a sentiment perspective, from an earnings perspective, we see that picking up, and applying these different lenses of valuation, economics, momentum, sentiment. Those kinds of things have us skewing for a risk reward that's slightly better, and it's paying off now since we've made our shift from kind of underweight to neutral to overweight. But we're not to the right on everything. I think I'll take exception with that. But I think we're trying to give investors, especially with a conviction rating, a sense of where we would be positioning just in a buy and hold strategy, and of course, relative to the environment, then it's already shifted on. So these things have moved around quite dramatically. We've trimmed our gold positioning, for instance. We've trimmed some of our oil positioning, which we carried as a hedge, and ZAR hedges we pulled back, and now re-externalizing. So there's a lot of movement in these portfolios.
Okay, perfect. I've been reading a lot of press around the elections, SA elections. I read an interesting article from this morning actually about, do elections, post-election, do they drive recessions? Do they create massive negative periods of economic, not growth, but impact in economy. I mean, and they were saying that mostly global factors or other factors outside of elections actually result in those market movements, etc. If you're looking at SA equities, I mean, do you think there's a lot of different scenarios from an SA election perspective, but do you think the risks are priced in terms of how the elections could potentially play out later this month?
No. I mean, I think you could make the case, but I think more things can happen than will happen again. I do think some of those really bad outcomes have been priced a little bit out of the market. But I think we must also remember that markets move ahead of events. We see it with fixed income defaults. Markets price in that default quite quickly, and actually when the default happens, you get bonds performing pretty well from there. And you get devaluations in currencies and things happen, Egypt, China, etc. There have been devaluations. We mentioned Japan, for instance, with its currency falling, equity markets done really well. There are specific reasons for that. But I think, coming back to your point around the election, I don't think that we necessarily get a big change in government policy in South Africa. But clearly there is a shifting rhetoric. Now, is South Africa a fertile place to invest for a long-term investor? I don't think that our environment lends itself to that. And when you look at the actions of BHP buying Anglos but ignoring certain assets, you look at the development with Shell wanting to divest of its downstream petroleum operations, and Gwedi saying, if you do that, we're going to sort of look at the upstream licenses that you've got, and all of that is rational. But it shows you that investors are losing patience with the South African investor environment. And it's not just international investors. Kevin often highlights the amount of capital sitting in bank accounts from the corporate perspective. There's very little corporate activity. Private equity is doing nothing in SA, and that on itself, from a kind of contrarian perspective, becomes interesting. We are anything but contrarian. But I do think it does raise your eyebrows that maybe the shifting rhetoric and the loss in majority that the ANC is likely to have, certainly based on the scenario work that we've done and how our senior investors have handicapped those scenarios, we could get a world that maybe is a little bit more constructive. And that would translate into other places as well. It's not just South Africa.
Okay, perfect. Thanks, Marius. You made reference to the fact that you've taken more money offshore, and obviously if you look at your offshore allocation, you are overweight. So it's going to be two questions.
We're pretty aggressively overweight.
Pretty aggressive, yeah. So I'm going to ask two questions. The first question is, with the max being 45%, there's been lots of, not debate, but info flow on what do you think the optimal is. But where are you at in terms of that 45%? Obviously that'll be applicable to the growth fund, not necessarily the cautious fund. And then just link that back to JP Morgan. Obviously the strategic partnership for ourselves as a business is critically important. And obviously, as we've referenced before, it's an investment-led strategic partnership, not necessarily a business and distribution one. So I know your team's worked with the JP Morgan multi-asset team for the longest in terms of how our other teams are interacting with the teams. But what does that bring to yourselves in terms of optionality and diversity in terms of investment options through that JP Morgan? So that's the second part of the question.
So I think the first bit, and I hopefully alluded to that in the conversation earlier, is around the interaction with that team as part of our team. So, we may have differing viewpoints in the same way that within our team we've often got differing viewpoints, and we'll debate those and bring forward reasons and rationale and data points to highlight those viewpoints and express a certain way of investing in that idea. And I think that's the first component. So I think it gives us a rigor that a business like ours, even though while we're big in the South African landscape, we have a range of inputs now that are unparalleled, I would suggest, within the South African landscape. When we want to dig into a specific asset class, a specific region, we can access really bottom-up, granular viewpoints as well as expertise from a top-down perspective that will aid our conversations. So that's the first part. The second component is JP Morgan Asset Management ran north of 500 different investment strategies in-house. We've liked the environment for fixed income for a while. We got government fixed income horribly wrong last year. And I think JP Morgan got it horribly wrong in 22. We were less convinced on that bearish outcome, but over time it's worked for the portfolios. But where we've been crowding into much more is around credit, and not just investment grade, but high yield credit, and not just saying, well, we want to own a lot of high yield credit, because with credit the asymmetry is actually to the downside with defaults, right? You lose a lot quickly if you're wrong. So it needs to be an active strategy. And we deploying into JP Morgan, and they deploying not just in terms of where they're allocating and how they're allocating, but we utilizing things like multi-factor credit strategies.
Okay.
We're utilizing Japanese bottom-up strategies within that JP Morgan component. And of course, within our world, we're looking at what Rod's and his guys are doing, what Nessie and the property team are seeing from a global perspective.
Yeah.
We're very interested. I think we put it up there as one of the interesting areas that we focused on. It's becoming more and more interesting. We have no exposure to global property. Nick keeps banging the table around the valuations, but he agrees with us around the macro. But it could be a generational opportunity in terms of listed property and specific areas within listed property. And again, I think we've got expertise not just in-house, but within JP Morgan, and it just adds rigor to the investment process, to the different perspectives coming in, and then in terms of thinking around sizing of the positions.
And when you reference high yield credit, investment grade credit, investing in those types of asset classes, obviously your risk management overlay would come in terms of how you manage potentially that downside risk that you've mentioned.
Well, I think the downside risk is not so much around an absolute risk.
Yeah.
So these are not absolute return funds, but we want to think carefully. We don't think high yield or investment grade you want to own the index, for instance. You need to be very active, so you need a bottom-up investor managing those things. I think it's slightly different to equity because the credit risk is so much higher in certain areas. So over time, we would want to be much more active in something like a credit strategy.
Okay, perfect. I've got a question that's come through with regards to, we've chatted quite a lot about the SA political landscape, but Trump and the US. You referenced, already some in Europe, etc. There's some impact with potentially with the Trump presidency. But what would, if you can maybe just give the audience a view of what you feel that a Trump coming back into presidency could potentially mean for markets, and then what could the impact be on South Africa?
So the first part is saying I'm not supposed to talk about political stuff. Kevin's supposed to be the
but
political
you're
guy,
very-
but
you're
I'm
very
happy
good at
to
it.
run off piste, and I don't really listen to the rules too much. So
Bring it back to investments.
I think it's been very early that there are two runners in the US election race. And Trump seems to be really gathering steam, and the indictments against him seem to be going nowhere in the short run.
Yeah.
And so it's becoming a base case that you have to think that it's a Biden-Trump race. Now, whether it's a Trump outcome or a Biden outcome, I think we'll need to do more analysis on what that means. Clearly, a second term for Trump, you can expect maybe more of the same, but aggressively so. But I think that the fiscal response that we've seen, not just from the Trump administration in those early COVID days, but the Biden administration since, leads you to believe that fiscal spending is not going away anytime soon. And therefore, both of those incumbents, if they were to win, you have to factor that is going to be more fiscal, more fragility around fixed income, more spending, and potentially more extreme policies. You had Bernie Sanders and Elizabeth Warren advocating for free medical response. We've had student debt forgiveness. Biden hasn't stopped, right? He's going hell for leather, and I think we'll see the same from Donald.
And impact on SA?
I think an interesting one, and I think I'm going to be really shooting from the hip.
Okay, so
but I do think that a Trump presidency will be much more negative for SA if our politicians continue on their trajectory and their alignment around foreign policy.
Okay. I see we are pretty much at 3 o'clock, so I think let me just wrap up, Marius, if that's all right. I mean, ladies and gentlemen, I know there are some other questions that have come through, but in the respect of time, in terms of the webinar, I'm just going to the last slide, so sorry, this clicker's not going as quickly as I would like. But thanks again for attending. I hope you've enjoyed the discussion and the views from Marius. We will distribute the slides after this event. You'll be able to access them and go through them. Please chat to any of us at STANLIB, myself, our team. You've got our contact details to chat to any questions related to the webinar. Obviously, we've touched on the multi-asset cautious and growth funds, and thanks to yourselves for the support and for investing in those funds on behalf of your clients. And we hope that Marius has given yourselves insights and views that give you the right view going forward in terms of how he and his team will continue to manage these portfolios and hopefully continue to generate really good competitive returns, not just relative to peers, but obviously relative to what yourselves are looking for in terms of your investor outcomes. So once again, ladies and gentlemen, thanks for joining us. We really do appreciate it, and we'll catch up soon, either on another webinar or on our travels around the country. Thanks very much. Appreciate it. Cheers.